Welcome to our channel. Today, we're diving into the comprehensive guide on the disadvantages of owner financing, also known as seller financing, in real estate transactions. While this method can attract buyers and facilitate deals, it's important to understand the potential downsides before deciding to be the bank. Let's explore these in detail. Time is money. First, let's talk about time. One of the significant drawbacks for sellers is the delay in receiving the full purchase price. Instead of getting paid in full at closing, sellers receive monthly payments over an extended period. With inflation always eating away at the value of your loan, the amount of time it takes to get your investment back is the main concern. A $1,000 payment at the 180th payment has a lot less value than $1,000 next month. What will a $1,000 monthly payment be worth in 15 years? Possibly $200 to $500 in today's money. Inflation risks. Another significant factor to consider in owner financing is inflation. Inflation can erode the value of the payments you receive over time. For instance, the money you get today will not have the same purchasing power 5 or 10 years down the road. This means that the longer the repayment period, the less value each payment holds due to the rising cost of goods and services. If the interest rate on the loan does not adequately compensate for inflation, the seller ends up losing out financially. For example, if you have a fixed interest rate on the loan, but inflation rates soar, the real return on your investment decreases or even be negative. It's crucial to consider inflation when structuring an owner financing deal. Consulting with financial experts can help you devise strategies to protect your investment from inflationary pressures. Administrative hassles. Next, managing owner-financed transactions involves considerable administrative work. Sellers must keep meticulous records of monthly payments and prepare annual mortgage interest statements. To avoid these administrative burdens, many sellers use professional servicing companies. The role of bill collector. Sellers also find themselves in the role of a bill collector when payments are late or missed. This includes chasing late payments and ensuring the buyer maintains the property, pays taxes on time, and keeps a current property insurance policy. This can be stressful and time-consuming. Foreclosure risks. Foreclosure risks are another major concern. If the buyer defaults, the seller may need to initiate foreclosure proceedings, which are costly and time-consuming. In a declining real estate market, there's also the risk that the property's value might drop below the outstanding loan balance and a loss would occur. Additionally, properties are never in the same condition as when the property was purchased. Large renovation, capital, and time might be needed to get the property back in condition for resale. Borrowers' bankruptcy risks. One critical risk in owner financing is the possibility of the borrower declaring bankruptcy. When a borrower files for bankruptcy, it can significantly disrupt the payment schedule and potentially lead to financial loss for the seller. In a bankruptcy scenario, the borrower's obligation to repay the loan may be temporarily halted or modified by the court. This means that you, as the seller, might not receive payments for an extended period, or you may receive reduced payments, impacting your expected cash flow. The type of bankruptcy filed also plays a role. For instance, under Chapter 7 bankruptcy, the borrower's assets are liquidated to pay off debts, but this may not cover the full loan amount. Under Chapter 13 bankruptcy, the borrower might be allowed to keep the property, but will repay the debt under a court-approved repayment plan, which could extend the loan duration or reduce the payment amounts. In some cases, you might have to initiate foreclosure proceedings to reclaim the property. However, foreclosure during bankruptcy can be a lengthy and complicated process, requiring legal expertise and additional costs. It's essential to consult with legal professionals to understand your rights and options if a borrower declares bankruptcy. Properly structured financing agreements and thorough vetting of the buyer's financial stability before the sale can help mitigate these risks. Selling the note at a discount and illiquidity. Sellers who tire of managing monthly payments can sell the note to an investor for a lump sum of cash. However, this typically involves a discount, meaning the seller receives less than the total value of the remaining payments. The discount rate depends on factors such as the property's equity, the interest rate on the note, the buyer's creditworthiness, and the terms of the financing agreement. Additionally, seller-financed loans are generally illiquid. This means that converting the note to cash quickly can be challenging and often requires selling at a significant discount. The illiquidity of these loans can be a major drawback for sellers needing immediate access to funds. Legal complications. Legal complications can also arise. Owner financing involves complex legal paperwork requiring professional legal assistance to protect the seller's interests. This adds to the overall cost and complexity of the transaction. Interest rate risks. Interest rate risks are another concern. The agreed-upon rate at the time of sale might not remain competitive with market rates. If market rates increase, the seller may find the interest they are earning is lower than current rates, leading to a financial disadvantage. Property management. Property management issues can arise if the buyer fails to maintain the property. The seller may need to step in, leading to additional responsibilities and costs. Buyer credit risk. Buyer credit risk is also a factor. If the buyer's creditworthiness declines over time, the risk of default increases. Monitoring the buyer's financial health can be challenging and time-consuming. Depreciation risk. Depreciation risk is significant in volatile or declining real estate markets. If the property value drops, the seller could be left with an asset worth less than the outstanding loan amount. Market fluctuations. Economic downturns can affect the buyer's ability to make payments, increasing the risk for the seller. Economic recessions can lead to increased defaults and financial instability. Regulatory changes. Regulatory changes can negatively impact owner-financed agreements, imposing additional requirements and increasing compliance costs. Insurance complications. Insurance complications can arise if the buyer fails to maintain adequate coverage. The seller must ensure the property is insured, and at times the lender might have to purchase property insurance coverage for the borrower, which can add to their expenses. Tax implications. Tax implications are another consideration. Sellers need to stay compliant with tax laws, reporting interest income from the financed note and other state laws or regulations. Consulting with tax professionals is essential. Record keeping. Maintaining accurate records over the life of the loan is necessary but time-consuming. Detailed records of all payments and outstanding balances are crucial to managing the loan effectively. Title issues. Title issues can complicate the sale and financing process. Ensuring the title is clear and remains so during the financing period can be challenging. Liability risks. Liability risks can arise if the buyer defaults, exposing the seller to potential lawsuits and financial liabilities. Proper legal protections are essential to mitigate these risks. Negotiation challenges. Negotiation challenges can occur if the buyer faces financial difficulties. Renegotiating terms or a forbearance agreement might result in reduced payments or extended loan duration, impacting the seller's financial plans. Exit strategy limitations. Developing an exit strategy if the seller needs to liquidate the note quickly can be challenging and may result in financial loss. Reputation risk. Negative experiences with owner financing can harm the seller's reputation in the real estate community and the local community at large, making future transactions and business opportunities more difficult. Even though the lender did not do anything wrong, no one likes the personal that took the family's house. Family or partnership disputes. Family or partnership disputes can arise if the property is co-owned by the borrower. Clear agreements and communication are essential to prevent and resolve such disputes. A divorce or partnership dispute can wreck the repayment ability of the borrower or borrowers. Despite these disadvantages, many buyers and sellers find owner financing to be a mutually beneficial solution. Working with qualified professionals can help navigate the complexities and mitigate the risks. Thank you for watching. For more insights into real estate transactions, be sure to subscribe to our channel and check out our article.